TikTok parent Bytedance Limited saw its operating losses more than triple last year to above $7 billion, according to a financial report shared with employees that offers a rare look into the private company's closely guarded finances. Bytedance issued the financial report as part of a special issuance of restricted stock units to more than 30,000 of the company's employees. The stock grants were first reported by Reuters. Company's operating losses in 2021 totaled $7 billion, up from $2.4 billion in 2020. Its net loss widened more than 87% to $84.9 billion in 2021. Revenue reached nearly $18.3 billion for the first 3 months of 2022, up almost 54% compared to a year prior. And it showed it's beginning to rein in its expenses, with its net loss for the period coming in at $4.7 billion, 84% down from $29 billion a year earlier. For more on these, we speak to Afosa Aluyi. He is the head of investments at Sankore Global Investments. Afosa, good afternoon to you. Thank you so much for joining us. Starting with Bytedance, is this the model that we've come to get used to for, I guess, early stage tech companies, rapid growth while posting losses as they go along?
Well, absolutely. I mean, it's pretty much the kind of model that we've come to see and know. I mean, for Bytedance, we've seen, market share grow quite significantly. Revenue has also, popped quite significantly. However, for it to continue to push those revenue figures and to pursue and focus on growth, it has to spend quite a lot of money. I mean, chief of its major spend will be around, spending on research and development, selling and marketing. These are things that will continue to eat into its revenue base. And, this is a model really that comes to stay for a lot of tech startups, where they have to burn through quite some cash to continue to grow market share. I think the ability, however, it's important that they are then able to rein in those costs at some point as market share continues to grow. And I think that's the path that I believe Bytedance is on. We've seen them, try to rein in, costs. We've also seen them beginning to look at, other areas of the market. They just made an acquisition of a video conferencing business for about $4 billion. We've also seen, costs starting to drop, significantly year on year. So I think that they essentially are on the right path, but this is really the path to go. And this is like an inflection point at which they need to start to bring, that cost down whilst they continue to focus and pursue growth.
All right, and you mentioned that acquisition of that video game company for $4 billion. Would you describe the expansion as aggressive, looking at that kind of acquisition that you just mentioned?
Oh, absolutely. It is aggressive, and they have to stay aggressive because it's a highly competitive market out there. With the kind of war chest that they have in terms of cash, it only is expected that they will continue to be aggressive in terms of growing their market share within their niche market, whilst also extending their tentacles into other areas where they believe that they can certainly scale and grow.
The long term, can you see TikTok being or maintaining its competitive edge against the Instagrams, Facebooks of the world?
I mean, that's really difficult to say. I mean, TikTok came along just not long ago and essentially has, taken everyone by storm. So who says that we're not going to see another player come along, in another year or so and then sweep everybody off of their feet? So it's really tough. That field is a constantly, rapidly evolving one. Innovation is at the speed of thought in that area. So it's very tough. But with their war chest, they might be able to defend their ascendancy for a little while longer.
I want to move to AMD. What do you make of the cut in its revenue forecast?
Well, I mean, it's really not an isolated situation for AMD. So if you look at guys like Intel, you look at guys in that chip business, really, and that's in the conductor business. It's been a slow quarter for them, and that's really on the back of the fact that we expect PC demand to kind of slow after a really strong growth over the last 2 years. That's the expectation, really. Also, the global economy is essentially going into a period of a slowdown. That would certainly play into the ability of these chip makers to grow revenues and obviously maintain margins where they are. I mean, we saw a really strong growth spurt during the pandemic, particularly demand for PCs, handheld devices, and all of that. It grew quite strongly during the pandemic. But as the pandemic has kind of, one-off. We're beginning to see demand there start to taper off, and that's tapering off into a slowdown in the global economy. Also, supply chain disruptions have not been helpful in this situation. So AMD really isn't alone, and this isn't surprising. I expect that this is likely to continue through 2023.
Is it, I guess, safe to say that the pandemic boom for electronics, particularly desktop PCs and other electronics, is over?
Absolutely, it's petering out. That much I can say. Global PC shipments are set to decline about 12.8% this year. Tablets alone, demand for tablets globally is retreating by about 6.8%. We only expect, demand for these things to continue to trend off and to drop. And that will certainly have an implication for players within that market. The pandemic created a situation where people were stuck at home and the demand for these devices really grew. Now, life is essentially going back to almost how it was or how we knew it pre-pandemic. And, the demand for these things, or the demand that, the pandemic basically foisted on us is beginning to taper off.
So if supply chain issues persist and we see an impact on semiconductors, what's the wider impact on the tech that depends on those chips?
I mean, the wider impact just simply means that we're going to see delays. We're going to see reduced shipments as well. But again, that could lead to a situation where prices kind of start to rise. But we're going into a situation where there is a slowdown generally, and that slowdown would essentially act as a counterbalancing effect on those supply chain issues. If the global economy remains strong and remain robust with supply chain issues, clearly it's going to continue to stoke inflation. However, as we go into a slowdown, as demand starts to taper off, that will serve as a counterbalancing effect to the supply chain distortion impact that we're seeing.
So still on that point, would you then say the global recession is already here, or it's imminent, or what's your takeaway, I guess, of the wider global economy?
I think we're in a slowdown. The question really is around how long and how deep the recession is going to be. Whether we're going to have a recession or not really isn't the question at this time. We're already in a slowdown. I think that the recession is imminent. The question really is, are we going to have a really deep, long-drawn recession? Are we going to have a quick one where, we have a slowdown, a contraction for a quarter, and then everything seems to recover very quickly? I think that's where the question is. But there really isn't any question around the fact that we're certainly heading into a global slowdown.
Fosa Aluyi, Head of Investments, Sankore Global Investments, thank you so much for taking the time to talk to us. We really appreciate it. Thank you so much.
Thanks for having me.